One of the most important things to understand about your retirement spending is that your spending patterns will change over the course of time. So in today's video, we're going to talk about how will those patterns change and what does it mean in terms of how you need to invest your portfolio differently to account for this. Joining me today is Erin. Erin, thanks for being here.
Thanks for having me.
When people are working, it's easy enough to fund their lifestyle. You have a paycheck, you have cash flow, any monthly expenses, those are coming from your paycheck, any kind of one big one-off expenses you're saving from, and then you retire. And that paycheck obviously goes away. And not only are you thinking about how do I fund today and tomorrow, but you're also thinking of how do I fund 10 years from now, 20 years from now, 30 years from now, using this one portfolio asset, maybe in conjunction with other resources to do so. And so we're going to talk a lot about that today. And as you're thinking about that, even I think the biggest thing is, what does spending look like for people in retirement? Where should people even start when it comes to understanding what their portfolio needs to look like to match their spending in retirement?
I think, even before you step away into retirement, at least like the 5 years leading up to it, you should really be tracking what your expenses are. I kind of lean towards the side of having a paid off home if you can get that big expense out of the way, but you should know what your day-to-day expenses look like, what your major expenses look like. If you have any big expenses coming up, like replacing a roof or having to replace a vehicle, but like 5 years out before retirement, I think is a really great time to do like a detailed tracking so you don't get to retirement and then you're like, oh, I didn't even know that I had this expense coming in June and it's an extra $5,000. So where's that money going to come from? So detailed tracking, I would say. What would you say?
Yeah, I think that's a great point, because I think that it's easy enough when you're working, just I've got a salary and there's enough margin in there to be okay.
Yeah.
And that goes away when you're retired. And it's less about starting with income in retirement. It's more about starting with expenses.
Yeah.
And then where do you pull income from? Whether it's
Yep.
Social Security or pension or your portfolio or cash savings, or you fill in the blank. And that's why it's so much more important to understand what exactly are those expenses. And I think a big thing that people, I don't want to say get wrong in a bad way, like they just don't know, is, okay, let's say that number is $100,000, just to use a
Yeah.
nice, simple number. I know for a lot of people it's not that, but that's a round number. We're going to go with it. They might think, okay, if 100,000 is the number and there's inflation, does that mean next year I need exactly 103,000 and the following year I need 106,000 and change, and the following year? Is that the right way to think about it once you do have your number?
I don't agree that your expenses go lockstep with inflation, because things for the vast majority of retirees, right? Most retirees are homeowners. There are a lot of renters and they can expect that their housing expenses will increase. But for retirees who either have a mortgage or if their home is paid off, well, your housing costs aren't going to change that much. Yeah, your taxes will, your insurance will, but they're probably not going to increase at the same rate of inflation. And you can do things to sort of adjust your lifestyle. You can adjust how often you eat out. You can adjust like what kind of groceries you buy. So if you plan that, you can kind of be a little bit flexible with your spending. You could change how you take a vacation. Do you fly business class or do you fly economy? I think there's modifications you can make, but I don't think it's a perfect coordination with inflation. I think your expenses might go up a little bit, but I think they go up less than inflation is what I would say.
Yeah. And by the way, for everyone listening, Erin has a YouTube channel called Erin Talks Money. It's a great channel, lots of awesome resources. I'm going to put a show link in not a show link, but a link to your channel and the resources. Everyone check that out, because this is really important. It seems sometimes like it's cutting hairs. Okay, are my expenses going to adjust by inflation, or is it going to be slightly less? And that's incredibly important, because that then allows you to back into your portfolio. And how should it be invested? And what role does it play over the course of your retirement? And you were telling me about a piece of research you were looking at even in the last week, but there's a piece of research that's commonly referred to as the retirement spending smile, that essentially says, look, use that $100,000 mark as an example, just as a ballpark of what you might spend. You need to maintain or keep up with inflation. Mm-hmm. So your real spending maybe doesn't increase if $100,000 buys the same basket of goods and services today as it does 5, 10, 20 years from now, when keeping up inflation, until you start thinking about the fact that that's not actually how people spend. And this research shows that typically, I think it's age 84 is when expenses, not peak, but the opposite of peak. That's when expenses are at their lowest. And what the research shows is if $100,000 is the number you started with in retirement, you're actually spending closer to about 75,000, more or
Mm-hmm.
less, by age 84, which means there's been a 25% reduction in real spending. Now, that doesn't
Mm-hmm.
actually mean you're spending less money each year. It just means that if inflation's increasing by 3, maybe your spending's going up by 2, or your
Yeah.
spending's going up by 1% year after year. So you were talking to me about some other research that you were recently looking at. What did that indicate as it talked about spending patterns of retirees?
This research came from Chase. So they looked at 5 million households and they noticed during the first phase of retirement, we can call that like the go go years, that spending actually increased on a real rate about 2%. And then once you get into those mid retirement years, spending did increase still, but tended to slow down a little bit. Maybe it increases at, say, 0.5% a year. Then you get into the very later stages of retirement. Maybe this is age 87, 90, 95. And spending really starts to take a dive here because most people are not, traveling to Europe or they're not going to Disney World when they're, say, 92. They could be, but most people aren't doing that. They're staying closer to home, maybe visiting family, some social activities. So you'll see that spending in healthcare in this time tends to go up, but real spending overall, because it's declining in pretty much every other category, really tends to decline.
Mm-hmm. And I think that makes intuitive sense to people when you look at it. If I were to say, those of you who are 60 and about to retire, imagine what the next 12 months are going to look like. Are you going to Disney? Are you
Mm-hmm.
going to Europe? Are you doing all these active things? Like, imagine that.
Yeah.
Now imagine life as an 84-year-old. What's different? And say, oh, of course, I'm probably not
Mm-hmm.
doing some of this. I'm still doing some of it, but I probably don't
Yeah.
have the energy. I probably don't have the desire. I probably don't have. It's just going to look different. You're not going to
Mm-hmm.
be doing the same things. And so it's not like, hey, Erin, you got to take a major pay cut at some time in your retirement, as much as your desires and your spending just gradually starts to taper off.
Mm-hmm.
And these small changes year over year over year leads to a pretty big change when you fast forward, say, 20 years into retirement, as I just talked
Yeah.
about, of you might be spending 25% less in real terms
Mm-hmm.
later in retirement than you are today. I want to talk about the implications of that a little bit. It's funny. I was just talking to someone and they were looking at their retirement plan and their Monte Carlo probability of success and all this stuff. And they weren't, this was just someone I was talking to, not a client or
Yeah.
anything. He said, it's at 70%. I want it to be higher.
Mm-hmm.
That's a separate topic. I think people get too dialed in on one number without understanding full context. But
Yeah.
this is one of those things where if you model this out and say, what does your plan look like when you do, say, inflation adjusted spending? Take that 100,000 and you simply adjust it for inflation from the day you retire until the day you die.
Mm-hmm.
What is your probability of success? Versus what if you model that same exact thing out, but applying this type of an approach of the average retiree actually not keeping their spending up in line with
Mm-hmm.
inflation every single year? It can make a huge difference. It
Yeah.
can be the difference between, I'm just going to throw out arbitrary numbers, a 70% probability of success to all of a sudden it's 82%
Yeah.
probability of success. Not to get too locked in on that number, because I think that number can be misleading, but that's a major implication.
Mm-hmm.
That means that maybe you don't need to save quite as much to be able to
Mm-hmm.
retire. That means maybe you can spend more in the first few years of retirement without sacrificing the longevity of your portfolio. That means different things in terms of even how should you invest to fund different stages of your retirement. So how do you think about that? Or do you have any guidance when it comes to telling people or sharing how should you be thinking about your portfolio in the context of all that?
One of the things, just speaking about the stats of, say, like a 70% probability of success or like the 80% probability of success, one thing I like to tell people is that you have flexibility with your spending. For the vast majority of people, there are ways you can cut back if, say, you want to do a lesser withdrawal. You don't have to say your budget is 100,000. I bet there's modifications you could do that maybe next year you could do 95,000 if you were feeling a little uneasy. There's small modifications you can do that add up. I still believe that you should plan for a long retirement and you should be invested. And I think focusing, like you said, too much on those probability numbers, people get a little hung up. Like they want to have like a 95% probability of success or 100% probability of success. But if you look at other stats, maybe we consider the rule of 4%, right? Like people withdrawing just 4% plus inflation on an annual basis. The people who follow that path, 95% of them end up with more money in 30 years' time than they actually retired with. So overwhelmingly, the vast majority of people are successful when they follow these guidelines. So I'm like you, I don't get hung up on the 70% probability of success, because when we look at those are usually factoring in something like the Great Depression or these absolute worst case scenarios that we don't really see that often. Not to say we couldn't see them again, but I think if you have different buckets to draw on, if you can remain flexible in your spending approach, that you don't have to get so focused on the number.
That's right. That's right. With those buckets or with that spending approach, the easy part when you're working, what bucket do you draw from for your spending? Well, it's your paycheck. That's coming in biweekly or whatever it is, and that's no longer the case when you're retired. You need to think about, okay, I'm going to have what you might refer to as the go-go years early on. I'm taking those Disney trips. I'm taking those trips to Europe. I'm doing more stuff. That might taper over time. Maybe in the latter years, there's healthcare expenses. So how do I replicate, maybe not dollar for dollar, but the role my salary previously played in my ability to live my life, even once that salary goes away with my portfolio? Do you think about, does this change the way you think about how people should be invested in their retirement years?
I'm still a pretty big advocate for making sure you have exposures to equities, because inflation is going to happen. The purchasing power of your dollar will reduce over the course of years and decades that you have in retirement. So I think you have to make sure that you have a portfolio that's still capable of growth. Now, everyone's exposure to stock kind of depends. Like, how risk averse are you? Are you capable of absorbing a lot of risk? Can you have these major fluctuations in your portfolio? Do you want lesser fluctuations? But I really don't think for the vast majority of people that we should dip below at least 50% in equities, because you have to have some growth over those years to maintain your purchasing power. And I really think people underestimate the role that Social Security will play in their retirement. A lot of us who are very just strong advocates for investing, we focus on what our portfolio is and trying to have our portfolio just replace 100% of our income. But for a lot of people, Social Security could be $2,000, $3,000, $4,000 a month. If you are a high income earner, that's going to go a long way towards supplementing your retirement income, especially if you're in a dual income household.
Yeah, fully agree. And I think that one of the things that trips people up a lot in retirement is not only do spending patterns change, like we're talking about, maybe it starts at whatever the dollar amount is day one and slowly tapers over time. So the actual amount that you spend changes. So too do income sources. Maybe you're that individual that retired at 65 and you're not going to collect Social Security until 70.
Yeah.
So what you have is both higher expenses, because you're probably spending the most in those first few years, along with lower income sources that you should definitely not be discounting. That Social Security benefit will be huge, but it creates this bigger chasm. More spending, less help being Social Security to help meet some of these needs. So your portfolio, the demands on your portfolio are much greater. Compare that to maybe 10 years in, both your spending has decreased, your Social Security has increased. Maybe there's a spouse where their Social Security benefits come in. Maybe they had their mortgage paid off, like you talked about more, Erin, before going into retirement, or they did not, I should say, and now it is. And so that's an expense. So there's these things that your portfolio is not just this constant. It's not just, I'm going to spend 4% forever. You're probably going to want to tailor that to what your actual needs are. And that need might be greater at the beginning when there's no Social Security and greater expenses, and that need might change over time as uneven income flows happen, as uneven expenses happen. And I think that you're exactly right that we cannot get too conservative with our investing. The temptation is to say, I'm at retirement, I now need to protect.
Yep.
And you do need to protect, but what you need to protect is your purchasing power, not the nominal dollar amount of your portfolio, which would mean stick it all in cash, stick it all in fixed income, stick it all in something that's safe today, seemingly so, but incredibly dangerous over time if you're not keeping up with inflation. So I think that just a good rule of thumb for people is, I'd like to know how you think. The way I think about this is you invest in stocks because that's the growth engine of your portfolio. Bonds are not. Cash is not. Those are almost like the moat around your castle, around your portfolio. Those are the things that we depend upon because stocks don't just go up, because stocks do go down 20%, 30%, 40% or more. So can we set aside, say, 5 years of living expenses is this common number that I like to start with, to say something that's fully insulated from the impact of a market downturn. But what's interesting is that 5 years of living expenses that you might need, say age 65,
Hmm.
if Social Security doesn't start until 70, that could be a lot of money because your
Yeah.
portfolio is fully generating everything. Fast forward 10 years, you have Social Security, your spouse has Social Security, your spending's decreased. Maybe there's a lot lesser of a
Hmm.
need from your portfolio. Well, that should shift the way you even think about how you invest to meet your needs. So part of the shifting landscape, you don't want to overcomplicate it, but there are some nuances to retirement planning that people should be aware of to make the most of it.
I would say that's an approach that I very much agree with. I think everyone should have this huge cash buffer that they go into retirement with. And I kind of like to pay attention to what the market is doing. If we have a very robust market, like what we had last year, it's up 20+%, I wouldn't actually touch my pool of cash. I'd be the person who draws from my portfolio because it's at peak levels. So why not take a withdrawal when it's high? It can absorb anything we take out of it at that point. My cash reserves, I want there for when the market is on a downturn. But I love the idea of like a 5-year cash bucket, or even if people can't get to a 5-year cash bucket, a 2 or a 3-year cash bucket. But you just don't want to touch your investments, especially in those first couple of years, because you can jeopardize the long-term viability of your portfolio if you're drawing in those first years when it's down. So if it's down, I would turn to the cash bucket. If it's up, I would go from my investments. And even, as you said in the beginning, when maybe you're spending more, I would be fine with people taking more than 4%. If you want to do a 7% withdrawal and 8%, and because those are your high expense years, if you have a robust portfolio, it can absolutely sustain that. And then as you get down the road and you have a lower draw on your investments, totally fine. I don't think there's like this static number, but I don't like to put out there like, oh, you can withdraw 12% every single year. Yeah, that's not going to last. But I do think that's fine in your beginning years. If you have a robust portfolio, absolutely, you can go way above that 4% number.
Yeah. And I think that's a big takeaway that I would add to this conversation of how do spending patterns change over time?
Mm-hmm.
And what's the so what of it all? Why does that matter? Why that matters is, one, to accurately project what you might spend. And big nuance there is we're not average. So just because the
Yeah.
average spending pattern is this doesn't mean that
Mm-hmm.
Erin's exact spending pattern will be that. Doesn't mean that my exact spending pattern will be that. So you still do want to take that into account. But number two, what this means, practically speaking, is typically the demand from your portfolio is going to be greater in those early years, and it is maybe going to taper off in latter years. What that means is it is okay. Give yourself permission. If you have a plan in place, and if you've done this right, to say you can exceed that 4% withdrawal, you can exceed that 5% withdrawal because you're not going to do it every year. You might do that for a couple years until Social Security kicks in and puts your withdrawal rate under 4%. Or you might do that for a few years while you're taking these trips, you're taking those flights, you're doing the fun things, knowing full well that that's going to decline over time. So that's where retirement research is so incredibly helpful to give us something to work from, but it has to be married to real life. And how do people actually do this? And what are the true implications? It doesn't mean you can't retire until you get your spending withdrawal under 4%, given some of these things we're talking about.
I mean, if you consider people, say you have a married couple and they both wait till 70 to take their retirement benefits from Social Security, they can absolutely fund maybe they retire at 65. They can do 5 years of withdrawals on a portfolio. And then they might get to 70. Maybe they don't even need to withdraw anything from their portfolio at that time. Maybe Social Security covers everything, or maybe there's a small pension that plays in. But I think people just have to look at these different income sources when they kick in and just be flexible with your portfolio. I think the 4% rule, it's a good guideline, but I think it's done just as much damage as it's done good in the financial community, because there are people who are married to that rule. And if you say you can withdraw 5%, you can withdraw 6%, people come at you like, I'm sorry, have you not seen the research? I'm like, yeah, I have, but it's okay.
Fully agree. Anything else, Erin, you'd add to this as we start to wrap up and leave people something to take away from all this?
I think just save early, save often. Your future
Save
self will
early,
thank you.
save often. I think that's an excellent point.
Yeah.
One final thing I'll say to this, even to the 4% rule. Yes, people are very married to that. Most people don't start with their portfolio and how much it can spend. They start with how much do I need, and translate that into what does my withdrawal need to be from my portfolio to supplement Social Security. So as attached as we get to that, realize that that's probably not the way you're actually going to be looking at things in retirement, as much as what do you need to supplement your other income sources to live the life that you want to live. Use these withdrawal rates as guardrails, as guidelines to make sure that on average you're doing it the right way, but look at the big picture while making these decisions.
And I would say to people not to reduce your spendings too much, because I know so many retirees just go in and they're like, okay, I don't want to touch this bucket of money that I've built up. And I mean, you spent your life doing that. Make sure you enjoy your retirement. So.
Yeah, absolutely. Well, Erin, thank you very much. Like I said, Erin Talks Money is her YouTube channel. I'll include it in the show notes. Thanks for the conversation, Erin, and we'll see you all next time.
Thank you for having me.
Root Financial has not provided any compensation for and does not influence the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.